Okay, so I wanted to do a review of my last trade, pltr, to tie up my trading style and give you kind of overview of what I look for. So everything that I trade is based on the movement of inventory. Everything is inventory and order flow. That is based on what the agenda for the company that day is, and then the algos do the executing. Knowing what goes on behind it, the market sometimes is really hard because, like, as retail traders, we want to know, you know, A plus B equals hit it, hit the bid. And there are systematic traders, and I trade that way sometimes with newer strategies, like everything is rule based and all that. But, like, I can't find a whack a mole approach to trading that's natural. Why? Because I see the order flow, and the order flow is constantly changing. It's like the ocean, the waves are always different. And so that's why I'm kind of a hybrid trader. I'm systematic but discretionary with my thought process. So I am this way because I don't know the rules of the Wild West. If there are even rules, I'm not in the mind of the person setting the agenda of the market or the market maker providing the liquidity, right? So even the market makers, they don't try and predict the market. They focus on the order flow. So why should I? You know, I know that momentum size traders and prop firms, they're the ones who try to predict the long term picture. And I'm not even close to that level as a trader. But what I do know is this: I know that we are not in a commission based market, and we haven't been since the algo wars. But we're in a asset gathering and management market, meaning that the big fish are receiving annual returns to manage and hold their shares, right? Taking a lot of the liquidity out of the market. Like, compare volume now versus volume in the early 2000s. So the first thing I do with any trade is I check the wells in the company. I know that, like, BlackRock and Vanguard are large global investment managements with the agenda to hold. Like, BlackRock alone has 7.4 trillion assets under management. Like, this company has BlackRock and, Vanguard holding like a billion shares. It also has pension funds, which I know they're going to be holding for decades. It also has, it has hedge fund activities, which usually try, like, 0.72 Bridgewater. I know that they, like, in general, a hedge fund is trying to suck the supply out of the market and let the price go up higher, and they're going to hold for like decades or years. So this means that this stock has good support and balance, and it has the bigger fish in it. Like, this tells me that who made this stock moves now isn't just like this stock isn't just a company that's just selling the free stocks or the restricted shares and hiring a stock promoter every time they want to raise the price to sell. Just off of this chart, I see that this is a healthy stock in the regards of it's being pushed around, by the right people. So that means everyday movement, though, is coming from prop firms and momentum traders operating off of credit, just like in a lot of shares today. So I give this one a medium strength go because of who's sitting in the, like, in positions right now with it. Okay, so it passed my first screening, right? So now that I've confirmed that there are institutions in this company trying to absorb the supply for long term holds, and now I need to figure out the day to day movement, right? Why is this important? Because I might take a position as an intermediate swing trader that plans on holding from 3 to 5 days. But if it goes the right direction, this 3 to 5 day trade might turn into me adding to the position in 3 to 5. Now, I wish I knew more about, like, what's important in the fundamental field, but I don't. So, like, I don't do much more research than this when it comes to fundamentals because I just don't know what's important and what's not, right? And I don't really need to because, like, the big fish that are already in this stock, have already researched the fundamentals with their team, so why not use them and their footprints for that? I guess my thought process is if the big fish are in here, then the company's worth its salt to, play in. All right, so now I need to see the liquidity in this thing. So I look at the float versus the 10-day average volume. And I can see that there is 1.53 billion available to trade on in the float, but only 77.59 million trading in the last 10 days. That's less than 0.5% of available stocks being traded. So referring to who's in this company, like Vanguard and BlackRock, if they wanted to sell their position, they couldn't. There just isn't enough liquidity to sell it, and it would take forever. Now I look at the short percent ratio and the short float, right? So the short float is 3.64%, and the ratio is 1.24, right? And the ratio and the short is like the jet fuel of the company, right? So when looking at the ratio, like it lets me know that if all of the shorts were to be trapped and squeezed, that it would take 1.24 days for them to cover their positions. So far we know that there are big companies in this. We know that there's not a lot of supply through liquidity in this company, which means when there's not a lot of supply but there's demand, price will go up, right? And then I look at the average daily volume, or my bad, average daily range, which is 4.05, which says, like this thing can get up and boogie. So a company with big fish in it have the range to move and no supply but demand, like it's go time. Like now it's time to refer to the charts and see if I can pull an entry point off the technical analysis and just try to paint the picture of what's going on and what's happened before. Okay, real quick, I want to talk about what kind of charting platform I use. These are market profile charts, and I mostly use them for futures and equity swing trades. And they break down 30-minute periods and layer them on top of each other to make a bell-shaped curve. They're extremely helpful in organizing the data for me to clearly see the inventory and that is trading from the float by using time and price. Seeing these it shows me the agenda that's happening, and each one equals 1 day, and I can break them down even more. And I literally can just use this chart just to see the structure, and I usually take very, very good structure plays off of these. And the three shapes that I care about, right? The normal distribution D shape, the P shape, and the B shape. And each one has a value and the standard deviations from to the extremes, right? And I can see clear as day the reversion to the mean trades and when price is discounted or in a premium range, right? All right, so the normal distribution shows me a trading range or the chop of the market when the tempo of order flow is slowly moving up and down, back and forth, right? The P shape shows me where the short position is, which the short position is selling something you don't own and trying to buy it back cheaper in a market. And like the P shape shows me that they're taking the short position there in an area where people who actually own it aren't willing to sell, right? So what happens is the P shape shows me the short position, and the people that shorted this are trapped. And what happens is you've got big buyers above them, so they're trying to buy it back, right? So, like when they go to buy it back, the buyers jump in front of them and raise the bid and jump in front of them. And we know that the market's moving higher. They go to jump, and then somebody else jumps them, and then they just leapfrog the bid back and forth to push price up, and trap in the short position. And we'll talk more about that when we actually see the chart. So then you have the B shape, right? Now, the B shape shows me accumulation, right? And usually happens when the market sells off. So let's talk about a B profile. Like the waves of buying hits a resistance or a wall or whatever, so it sells off, trapping everyone long to that point. Now, what happens when the market sells off? You see the market is long and it's sold off. So what happens is that this B that usually is short and squatty is where they accumulate. And we're gonna talk really in detail about what's actually happening when I show you the trade that I got in. But this is a quick, fast overview of these charts. So when I explain to you my steps, it makes sense. So in this market, every time a stock falls apart and conducts a mechanical low, it hits a reference point, level, moving average, etc., and bounces. It feeds me a piece of market generated information about what is to come, especially if the ES is correcting and the underlying stock has relative strength and just establishes a higher low. So right now, looking at this stock, right, I can see on day 2 it breaks out into a P shape on August 18th. It hits my scanners for having more relative volume than the last 8 days. And so it hits my scanner. I'm drawn to it. I see that day 2 is a P shape profile and the short position is in the green shaded area. So people must have saw the volatility correcting. So you can see a couple days before 1, it gaps up and then volatility starts to contract down, leading to this breakout, right? So as it breaks out on day 2, it fails to get to the my 26 level because breakout traders or size traders started taking profits, also trapping the traders who chase price, chasing the breakouts. Which as they took profits, it opened up supply. Now as the supply opens up on day 2, they need to find a buyer, which is why it moves down. It searches for a size trader to hit the bid on day 2 and 3. And as it starts hitting the bid, people start shorting it because it moved up in the breakout in a parabolic manner, right? So it sells off, bringing us to day 4, where it builds a short and choppy B-shaped profile. Why? Because someone is sitting there accumulating it on the bid. The smart short sellers are covering, hitting it on the bid at this time. Then the long traders go, oh, now it's not breaking the 23 level. I'll buy 10,000 shares, Well, I see that supply is drying up because look at the 45-degree angle from each 30-minute profile. It is time framing up. So when I see that, I see that I can't make it up to the 23 level. I go long 8 contracts. Okay, so let's talk about my entry and stop loss and zoom in on this, right? So right now, look at number 1, right? Number 1, market goes long. Longs take profit by selling. You got people trapped over there that chased, right? So they sell. Number 2, this opening up the inventory, the positions, market sells off and the bid keeps getting lowered and lowered looking for a buyer, right? Now, when the market sells off, not only do long sell, but knucklehead shorts initiate, right? We look at number 3, the bid is hit with size. Maybe it's short covering starting off. They're buying to close their position. Smart longs see this and buy to open. And knucklehead shorts, they continue to short the market, right? The next day, I saw that price can't go below the previous day point of control where the knucklehead short position was, and they were waiting to short. So I go long 8 contracts at $24. I put my stop right below the point of control from the previous day at $23.89, and with the plan to take half of my position off at $24.84, one of the balance zone levels that I came up with, and let the rest of the position to run because it's already paid for, right? Now, why did I do it this way? Because I understand what's happening I have a good feel for this stock because I've been observing it. And every stock, unlike the ES, has a different flow to it. So as the inventory is taken inside at number 3 by the prop firms and the momentum trader and the wholesale market makers in the B shape, I want it to follow their waves, right? I also know there are only 2 days above where number 1 is. Sorry about that. So I know that there's only 2 days of buying in the box where number 1 is, right? So what does that tell me? That tells me that, you know, like, it tells me that there's not a lot of position there. Like, there's not like 30 billion shares to sell right now. There's 2 days worth. Um, there's only a certain amount of product inventory. So once the selling is extinguished, the market opens and that drive, what's it driving off of? It takes out that high from the previous day B profile. And when it takes out that high, it creates that short covering, right? That shows me that it's over, right? And then it does an inventory correction, because it can't make it past my white balance zone level. And like an inventory correction is as simple as a retracement, allowing that the people who short it in bad areas to free up supply for the demand, you know. But not all of them get to close because there's a demand for this now. And so once all of the supply is absorbed, it's continued higher, leaving that short position still under the point of control, the purple line in box 3. Like there's still a short position there. All right. And so what happens is the next day it shoots up higher and establishes the P shape, right? The knuckleheads that shorted this are trapped in a bad location. And what happens is you get a big buyer who steps in. So during this, like the longs and the shorts are competing, by size, by jumping in front of each other. The longs are trying to buy the bid and open a position where the shorts are trying to close by buying their position back from where they shorted. And this finally runs out where all of it, and then they continue to accumulate at that level. You say put a big bid right there, preventing the shorts from continuing to, close the positions, leaving some of them still in a losing position so they can trap and squeeze them even harder. So look back at this B-shaped profile and look at the blue area in the market profile chart. That's the value area, which the most time is spent during those prices for that day. Like we see the 45-degree angle that represents two things: the shorts that shorted at a very bad position and supply shutting off. They are stuck underneath of that B-shaped point of control. The market goes up to where I have number 1 marked and builds more overhead supply, and then the market liquidates because the prop firms and momentum traders who accumulated in the B shape are now taking profits, and whichever size player who's trying to collect the most inventory is trying to shake everybody out. And look where it liquidates to. Like look at number 2, like the base of the value area of that B shape, which is right above where the short position usually is. Why did they do it that way? Because remember, just like in any other market, price is only an advertisement tool. So they bring it just down low enough to the point where the shorts can close their positions for a loss and not a profit, while trapping any leftover longs who chase the breakout. Now, majority of all day traders who traded during this week are trapped and shaken out, long or short, allowing that size trader who built this craziness to collect most of the inventory. And as you can see, it worked. And I'm still in this position, and we'll do 2 more videos to show where I added more shares and another one where I got in with options. Really hope I taught you guys something and this kind of exposed my playbook. All right, later.